The broadcast is now starting. All attendees are in listen-only mode.
Welcome everyone to Nova 401k Associates webinar, Introduction to 401k Plans for Plan Sponsors with Jason Worms and Tina Tufano. Before we get started, I would like to point out the panel on the top right-hand corner of your screen. You will see a drop-down section for questions. This is where you will enter in any questions you may have for Jason and Tina. Keep in mind that the Q&A portion of this webinar will be held at the end, and they will answer as many questions as time permits. Please be sure to make your questions as descriptive as possible and include the slide number if possible. If time runs out and you still have questions, please send them to our email address, webinars@nova401k.com. Right below, you will see the handouts drop down as well, and here you will be able to download any materials from today. If you are with us today to earn continued education credits, please be sure to stay until the end to fill out our survey. This will allow us to track your time and participation. Certificates will be sent out within a week. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you for joining us today. I would now like to introduce to you Jason Worms and Tina Tufano. Jason and Tina both work for our Defined Contribution Administration Department here at Nova. Jason is a team leader for this department, and Tina is our Senior Account Manager. All right, go ahead, Tina.
Thank you so much. Good afternoon, everyone. And I hope everyone is having a wonderful start to their spring. Unfortunately, the sun is not shining where I am, but I hope that it's shining where you are. So we're going to get started with our introduction to 401k plans for plan sponsors. Before we begin, a disclaimer. The information in this presentation is general in nature and not intended to be a substitute for legal or tax advice. Please consult a qualified professional such as an attorney or accountant if you need legal or tax advice. Also, as Yvette mentioned, if you need CPE credits, they will be sending out certificates after the presentation. Here's some information and Nova's provider number. Everyone needs to be registered individually, be present for the entire seminar, complete an evaluation form at the end of the presentation, and then within a week you'll receive your certification. Okay, this is our agenda for this afternoon. We're going to start with roles and responsibilities so that you'll know who is involved in the administration of your plan. We will also discuss Nova's cybersecurity measures, things that Nova is doing, and also suggestions for cyber measures that you should take as a plan sponsor. We'll discuss the 401k basics, moving pieces between the different administrative roles, distribution basics, loan basics, and also provide an annual calendar of some things that you can expect throughout the year with your retirement plan. Starting with roles and responsibilities, this is a great resource to keep handy if you'd like to print it out. And by the way, under handouts, you can print out the Introduction to 401k Plans PDF so that you can keep this in your records. But this right here is a great chart. We'll start with the top left-hand side, which is you, the plan sponsor. Who has overall fiduciary responsibility, communicating the plan to participants, remitting plan contributions, making those deposits into the plan, and providing data to the TPA, which is Nova, on an annual basis. The top right-hand corner is your financial advisor or your broker. The broker assists with vendor selection and monitoring, coordination of enrollment meetings with participants, and providing investment education for participants. Also, assisting the plan sponsor with 404C compliance with regard to investments and fee regulations. Bottom left-hand side is your investment provider, otherwise known as a record keeper or custodian of plan assets, where you will invest your plan contributions, and they will provide daily record keeping. The record keeper will also provide participant statements, and they will be responsible for distribution, withholding, and reporting. On the bottom right is NOVA, the third-party administrator. NOVA will prepare and maintain the plan documents. We will complete required annual testing, prepare annual filings, such as the 5500 for the Department of Labor, and we will provide ongoing plan consulting. So when you have those questions about what to do in certain situations, you know, with eligibility or any other issues that come up, NOVA will be your main contact. And if you are not sure who to contact at any point, you can always contact your account manager, and we can help guide you and point you in the right direction on whether or not it's something the investment provider, plan sponsor, or financial advisor can help you with. Okay, cybersecurity measures. Because of the confidential nature, apologize for that, don't know how that happened. Because of the confidential nature of retirement plans, there is a tremendous amount of importance with regard to cybersecurity. The bad guys have taken notice of that opportunity, unfortunately, and so they are going to do everything that they can to try to get access to retirement plan money. There have been coordinated attacks on record keepers as well. It may start from phishing attacks or hacking an employee's email, contacting the record keepers, and
Tina, can you move the Mattel thing over, because it's on top of the slide right now?
Oh, I'm sorry.
You're fine. There you go. Perfect.
Yeah, I had my phone shut off and then it turned back on. I apologize. Okay, so with new passwords, they can request loans and distributions if they access your password or reset your password. So so this is obviously a concern. Unfortunately, with ACH and wires, typically only trivial amounts are recovered when the theft is discovered. So it's much better to be proactive with cybersecurity than to wait until something bad happens. This type of theft, unfortunately, is not covered by things like the ERISA fidelity bond, fiduciary insurance, or E&O insurance. So, so we all need to be alert and do our part in preventing fraudsters from succeeding at cyber attacks. Okay, some measures regarding keeping things secure. You know, census files, deferral files, payroll files, address files all have confidential information, as well as the non-discrimination reports that we provide. ADP testing, top-heavy 415, and so on. Most of our software does mask Social Securities, but some do not. Annual evaluations will have confidential information in them. Tax forms, you know, W-2s, K-1s will have socials and compensation. So all of this information, should never be sent via email without encryption. Nova does have encryption software. So if you as a plan sponsor do not have that available to you, we can always send you an encrypted email so that you can reply to it, and it will be more secure that way. Distribution forms actually is another thing I wanted to mention. Distribution forms are commonly sent via email, and you want to be careful with that, sending it through email that isn't encrypted, because it has social securities and balances on there, as well as addresses. So Nova takes great lengths in trying to keep things secure on our end. We have a secure web portal, which is the plansponsorlink.com. And we use this for requesting census information at the end of each year. It allows for secure transmission of the data between both the plan contact to Nova and vice versa. We also have the encryption software, as I mentioned earlier, for email. Another thing is that, so new plan contacts need to be authorized in order to have access to the plan sponsor link, where we keep a lot of confidential data for you to access. So if you want to add someone as a contact, we do like to get that in writing via email, so that we can add them and give them access to your plan. Mandatory training is required for all Nova associates every quarter. So we are receiving IT training on ways that we can better improve and be aware of possible security issues. So we're always keeping our eyes open for potential threats. Also, Nova has an internal Nova password policy where all passwords are changed at least every 90 days. So we're making great efforts to keep everything confidential on our end. Okay, so as mentioned briefly, the plan sponsor link is used to receive data from the plan sponsor at the end of the year with regard to our census data, which we ask for so that we can prepare your annual compliance testing. There is also a secure file transfer option on the plan sponsor link that is just like a secure email. So only participants that have access to the plan sponsor link, whoever the plan sponsor authorizes to have access, will be able to receive emails from Nova, and vice versa. Plan sponsors can send Nova contacts a secure email through the secure file transfer. And so this is another way to send, this is another way to send secure information or secure files that we don't want anyone to get their hands on. It's a good idea to limit the number of people that is copied on emails, so that too many people aren't, seeing all of this confidential information. So just something to keep in mind. And also we suggest that you use complex passwords that can't be easily guessed, and to change them often. As mentioned earlier, Nova does, Nova employees do change their passwords every 90 days. And we suggest that you consider doing the same. Okay. If you have any questions about the security measures, of course, that we're taking or the suggestions that we've made, please don't hesitate to contact your account manager. And the goal is to keep the information here private. Okay, on to 401k basics. So retirement plans give employees an opportunity to save for retirement on a tax-deferred basis. Payroll deduction is the best way to save because it's easy for the employees and almost painless, right? It's deducted from their payroll check. And for many people, their 401k is actually their biggest asset outside of their home. And it has become the primary retirement plan for most people. So offering a retirement plan for your employees is definitely a valuable benefit. Okay, it gives employees an opportunity to, it's not. Here we go. Okay, 401k plans are heavily regulated by both the Internal Revenue Service and the Department of Labor. Unfortunately, common sense doesn't always help. You know, sometimes we think something may make sense to do it one way, but the regulation may say another. And the rules do frequently change. So, you know, it's always a good idea to ask if you're not sure, and your account manager is available for all of those questions. And we'll discuss later some examples of some things that may seem like common sense but aren't necessarily. In almost all cases, the plan document controls the plan. So we will refer to the plan document quite often. And can help you find the answers in your plan document as well. And the plan document contains all of the provisions for your plan, including eligibility, when participants become initially eligible for the plan, when they're entitled to receive employer contribution allocations, what type of compensation is eligible for deferrals, and the compensation used for allocating employer contributions, and so forth, and including, you know, when distributions can be taken from your plan. Okay. Compliance, the IRS basically oversees compliance with federal statute and IRS regulations. Their concerns are primarily with non-discrimination testing, taxable events such as distributions, deduction limits, which include, you know, how much you can contribute to the plan as a participant and as a plan sponsor. The IRS also oversees plan documents and making sure that they are timely amended and that the terms of the document are followed. So those are the primary concerns of the Internal Revenue Service. The Department of Labor, on the other hand, their primary focus is with the rights of participants, such as 401k contributions and loan repayments, making sure that they are deposited on a timely basis. So, you know, that money, 401k deferrals and loan payments, if it weren't being paid to the plan, it would be paid to the participant in payroll. So, you know, that is participant money, and the Department of Labor wants to make sure that it is out of the employer's hands on a timely basis and put into the participant's account where it belongs. The Department of Labor, and we'll talk a little bit about more later about deposit timing. The lineup offered to participants for investments, they want to make sure that that is prudent. And the Department of Labor also looks at expenses paid by the plan to make sure that they are reasonable. And finally, Form 5500, which is filed with the Department of Labor on an annual basis. They want to make sure that that is done on a timely basis as well. And failure to file the 5500 on a timely basis is subject to some penalties. So that's important. Okay, here's some things that I mentioned earlier that may come up that may seem like it's common sense, but not necessarily. For example, if a plan sponsor wants to exclude hourly employees from the plan can exclude certain employees. However, it needs to be written in the document, first of all. So as I said before, the document is very important. Following the document is very important. So one, it needs to be in the document in order to do that. Unlike other benefits that you may be able to just exclude hourly employees, it needs to be written in the document. You also need to pass IRS coverage testing as well if you're going to exclude employees. Coverage testing basically looks at the total of employees that are eligible to participate slash cover or that are covered by the plan compared to the total of non-excludable employees. And in general, the plan needs to cover at least 70% of employees. So a little more complicated than just saying we want to exclude certain people from the plan. There's definitely more involved in doing that. Okay, the preferred investment alternative for an employee who puts money into a plan but fails to make investment selections. This is common in 401k plans where a participant has opted to not participate and make 401k deferrals. However, the plan sponsor at the end of the year may decide to make a profit sharing contribution. And so if the participant hasn't set up their investment selections, where do you put that money? Usually there is a default investment that is set up. This is something that you would work with the record keeper on and your financial advisor to set up the appropriate default investment. I mean, ideally, we want to get participants to complete investment selections, but there are regulations to follow on default investments in case those investment selections are not set up by the participant. So, one common thought is that, putting the money into maybe a, money market account, and that's not necessarily, although it seems like common sense, until fairly recently, money market and stable value funds were commonly used. But according to recent DOL regulations, it's more appropriate to use a balance fund or life cycle fund. So timely deposit of 401k contributions and loan payments are very important, and is one of the first things that both that Department of Labor and the IRS actually look at if they're looking at a plan. So if you're not depositing contributions on a timely basis, it can result in the employer making up lost earnings and possibly paying a penalty. So it's really important to pay attention to this So we're going to go over the safe harbor timeframes. In January of 2010, the DOL did issue final regulations on deposit timing. For small plans, which are generally under 100 participants, deposits of employee money needs to be made by the 7th business day after the amounts are withheld from pay. For large plans that are generally more than 100 participants, it's a little bit different. The regulations say as soon as administratively possible and following the 15th business day of the month. However, this is meant to be a no later than rule. It's not meant to mean that it's okay to deposit contributions the 15th day of the month following, for each payroll. And that's not what it's meant to be. This is saying that this means that absolutely no later than the 15th business day of the month following should it be deposited. In practice, the Department of Labor usually determines that 1 to 2 or 3 business days is sufficient enough for large plans to make their contribution deposits. And the reason why is because most companies need to pay their payroll tax that quickly. And if you can deposit your payroll taxes that quickly, the Department of Labor generally feels that you can make your contribution deposits that quickly, that you have the resources to be able to do that. This is huge in Department of Labor audits, and also in the audit, if you're a large plan, you will need an audit from a certified public accountant at the end of the year to file with your 5500. And these are one of the first things that they look at. They will look at your history of deposits. So if you normally if you've been making your deposits, 3 to 4 business days, and you start making them the next day, within 1 business day, well, the Department of Labor and probably auditor will say, that you can do it in 1 day, even though, you've been doing it 3 days. If you've shown that you can actually do it in 1 day, then you can probably do it for all of your deposits. So that's just something to keep in mind. So the Form 5500 is submitted to the Department of Labor. It's an annual report of the plan, which includes basic information such as the employer name, plan name, EIN, the number of participants. It also includes the asset activity, such as contributions, withdrawals, earnings, fees. It's a way for the Department of Labor to keep tabs on your plan so that they know, 1, that the plan exists, and they can monitor, the general activity that's going on. So the 5500 is due 7 months after the end of the plan year, or an extension can be filed for an additional 2.5-month period. So if your plan year ends on December 31st, 2021, for example, your 5500 will need to be filed with the Department of Labor by July 31st, 2022. If an extension is filed, which we would do that for you, then the 5500 is not due until October 15th, 2022. The 5500 is an electronic filing. The process for getting what the Department of Labor refers to as credentials for signing the 5500 online. This would be, generally it's an officer of the employer that signs the 5500. And the process is fairly easy to get it, the credentials, and your account manager at Nova can help you and guide you in the direction. This is done through the Department of Labor website. But if you haven't done that yet, if you're a new plan, then we can certainly assist you with doing that. Okay, a part of the 5500 filing is to report the amount of the plan's fidelity bond, otherwise known as an ERISA bond or an ERISA fidelity bond. The bond needs to equal 10% of your plan's current assets. And although we suggest that we suggest that you talk to your insurance agent about having an auto escalation on the policy so that you aren't updating it every year. Maybe it's every other couple of years. But this is something that you can discuss with your insurance agent. We do ask for this information each year when we ask you for your census information through the plan sponsor link. Part of that request includes a request for basic information and on the plan, including some questionnaires. And this is one of the questions that we ask to make sure that you are compliant with the fidelity bond. And we ask that you provide the amount of that bond so that we can make sure that it's at least 10% of the plan assets. Certain plans need to attach a copy of an audit report that's prepared by an independent CPA. This is for plans with more than 100 participants, generally at the start of any plan year. However, there is an exception, which is under the transition rules. If you have 80 to 120 participants, if you have 100 participants this year and you didn't have, and you have filed and you're under 120 participants and you filed as a small plan the year before, then you can file as a small plan again. So we do look at all that. We look at that ahead of time when we're preparing your 5500. If you are approaching your small plan and you're approaching the threshold of becoming a large plan, we'll take a look at that and let you know that you are, could potentially become a large plan. And with that, it would require an independent audit to be filed with your 5500. The next item we want to discuss is payroll integration. Some of you may already have this. If not, it may be something to look into. What is it? Payroll integration is when the payroll provider submits full census data each pay period to your record keeper. For example, Paylocity will work with John Hancock. It will include information like addresses, dates of birth, dates of hire, termination, compensation, hours worked, and it includes all employees regardless of whether or not they defer. So the question is, why would you want to use payroll integration? There are several benefits, including the annual census data can be pulled from the record keeper and then submitted to Nova. Also, for automatic distributions, once a termination is received in the census file, your record keeper or vendor can send a distribution packet to participants. If the account is under 5,000, then participants can be forced out if there's no response within a 30 to 45 day period. Generally, this period depends on the vendor, and the vendor can help track enrollments by using payroll integration. Once new employee data is received, the vendor can send enrollment packets to participants once they're eligible. and census data that is updated at the vendor level so they can update information such as, like I said, dates of termination, dates of rehire, vesting information, etc. There are different types of payroll integration. And of course, this is something that you would want to discuss with your payroll provider and the record keeper to see which provider and record keepers work well together. But there are different types. The first is a payroll 360. And this is when the census data flows both ways. Census data is provided to the record keeper from the payroll vendor. And then also payroll changes sent to the record keeper can be provided to the payroll vendor, such as deferral changes, hardship requests, loan requests, etc. Payroll 180 only flows one way. So the census data is provided to the record keeper from the payroll vendor only. But there are several benefits for both options. If you're interested in learning more about this, we suggest that you reach out to your record keeper and payroll provider. And of course, if you have any questions, you can always reach out to your NOVA account manager. Non-discrimination testing. The ADP testing is the average deferral to percentage test. And this is for 401k plans, and it compares the amount of 401k deferrals that highly compensated employees are making compared to non-highly compensated employees. So it looks at the average of the highly compensated group, and it compares it to the average of the non-highly compensated group. There is usually a threshold where a window of deferral percentage that the highlies can contribute as an average above the non-highly compensated group. And so we take a look at that. Failures are usually corrected by issuing either a taxable refund to highly compensated employees so that it brings down the average deferral. Another option is to actually provide an employer contribution to increase the deferral average for the non-highly compensated employee. So, so there are a few choices when it comes to that. Who is a highly compensated employee? The highly compensated employees are owners, anyone that owns more than 5% in the current year or in the previous plan year. So for 2021, anyone who owns more than 5% of the company in 2021 or 2020 will be considered a highly compensated employee. Also, it's based on compensation. Compensation is on the prior year. So for 2021, a highly compensation, in addition to those owners, would be anyone who earned more than $130,000 in the prior year of gross compensation. Also, lineal family members or a spouse of a direct 5% or more owner working at the company will be considered a highly compensated employee. So it's important that you identify who the family members are when you're submitting the census at the end of the year. Because on their own, a child or a spouse may not have compensation enough to consider them a highly compensated employee, you know, but because of, you know, family attribution, they will be considered an owner and a highly compensated participant if they're a family member. So it's important that you let us know who those family members are and what exactly their relationship is. see. Okay. We also look at top-heavy testing. If the balance for key employees is more than 60% of the total balances, the plan is considered top-heavy. And this is important because top-heavy plans are required to make contributions for non-key employees. If key employees are making contributions to the plan. So it's important to determine this. And we're going to look at how we determine who a key employee is. A key employee is also anyone who is a 5% or more owner. But in addition to that, it's a 1% owner with compensation greater than $150,000, or an officer with compensation greater than $185,000. Those compensation thresholds do change each year for cost of living adjustments. So, but these are still the same thresholds for both 2021 and 2022 plan years. And of course, just like with highly compensated employees, family members are considered, family relationships are considered when determining whether or not someone is a key employee. So even though a family member may not reach this compensation threshold, if they are the child, spouse, etc., of a 5% or more owner, then they will be considered a key employee. So one of the good things about safe harbor plans, if you have a safe harbor plan, is that you are exempt from both the top-heavy and the ADP ACP testing. So you basically get an automatic pass. The benefit of that, it allows the highly compensated participants to not worry so much about their deferral percentage or their deferral average as a group. They can, they don't have to worry about refunds if they're meeting the safe harbor regulations. And also, it gives them a pass on the top-heavy test. We'll talk about the different types of safe harbor plans. The first one is a safe harbor match. So this is different from a regular matching contribution, but also similar. It is the matching contribution in a safe harbor plan is given to only participants who are contributing to the 401k plan. So if someone is not making a 401k deferral, they will not get a safe harbor matching contribution. The basic match formula, so the requirement to be a safe harbor plan is that the employer contributes at least this much, which is 100% of the first 3% of deferrals, plus an additional 50% of the next 2% contributed. So we're looking at a maximum of a 4% match based on their compensation, a 4% potential match. The other type of plan is a non-elective safe harbor plan, which is where all eligible employees receive a 3% contribution, regardless of whether or not they contribute. So even if they aren't making 401k deferrals, they will need to receive a non-elective contribution. This could end up being less expensive because it's only 3% of pay, but it also could end up being more depending on the demographics because you're giving it to everyone in the plan that's eligible, not just those that are contributing. Both types of safe harbor contributions are 100% vested. So that's where it can differ from a regular match or a regular non-elective contribution that are typically subject to a vesting schedule. These are automatically 100% vested immediately. Also just want to mention that with the safe harbor matching contribution, there is availability for enhanced matches, so that you can do a formula that's greater than what you see here. For instance, you could do 100% up to the first 4% of contributions. Okay, moving on to other types of non-discrimination testing. There is coverage testing, profit sharing testing, and compensation testing. So as briefly mentioned before, the coverage testing looks at the percentage of non-highly compensated participants, which are the employees or participants that do not satisfy the highly compensated employee requirements. So it looks at the non-highly compensated participants that are benefiting or being covered in the plan when compared to all of the non-excludable participants. And generally, the rule is that that at least 70% of the non-highly compensated employees need to be benefiting in the plan. And with a 401k plan that has a 401k and a match that has no allocation requirements, which means everyone gets a match even if they're, regardless of the hours that they work or if they're employed at the end of the plan year, then generally you'll pass the coverage testing on both the 401k and match requirements. Where it becomes a little, more important to look at the coverage testing carefully is when you have an employer contribution that has an allocation requirement, such as working 1,000 hours during the plan year or being employed on the last day of the plan year. So we do look at that to make sure that your plan is covering the percentage that it should be and is passing the testing. Profit sharing testing, there is, we look at there are different ways to allocate profit sharing contributions. And so we're looking to make sure that your profit sharing allocation is non-discriminatory, that it meets obviously the plan document requirements, and that it meets regulation requirements, and that you're not contributing more to the highly compensated participants than you should be. For compensation testing is primarily when you have compensation exclusions. Let's say you exclude bonuses or commissions from the compensation that you're using for allocating employer contributions. So you don't want to give, let's say you're doing a 3% contribution, you don't want to give 3% on the full gross compensation. You want it to be the gross compensation minus commissions and bonuses. Then we do additional testing to look at that to make sure that it's non-discriminatory. And basically all this testing, this non-discrimination testing, is comparing the highly compensated employees to the non-highly compensated employees and making sure that you're not discriminating against those non-highly compensated participants. Plan documents, amending them timely is important. It's important to stay current with new legislation. They need to be executed timely, when we send those to you, usually most amendments need to be signed by the end of the plan year, but we suggest that when you receive amendments from us, amendments that you've requested or restatements that are required, that you take care of it right away, because you don't want it to not be executed timely. And there are penalties for failing to execute them timely, so it's really important that be done. Now, the terms of the plan, as mentioned before, the terms of the plan document need to be followed. So there are always, there are options to amend documents or your adoption agreement to make changes with regard to eligibility, entry dates, and so forth. But it's important that you follow the terms of the document. If not, to amend the document to reflect what it is that you're doing. Eligibility, entry dates, compensation, employer contributions, vesting. These are just some of the terms in the document that we're following. Distributions, whether or not a hardship is allowed, and a hardship distribution, whether or not loans are allowed. So all of that is in your plan document. Here are some common plan sponsor and payroll errors that we wanted to mention. One is excluding bonuses from deferral elections. You want to make sure that the document says that it's okay and that bonuses are excluded. If bonuses are not excluded from pay, then you should be taking deferrals from those bonuses. Now, administratively, you can decide, you can set an administrative procedure that says that if you give a bonus to a participant, that either their normal deferral election will be deducted from that bonus, or you can allow them to make a separate election. For example, if participant is deferring 4% of their pay as a 401k deferral, you could just take the 4% of pay out of their bonus, or you can say, you can give them the option to have the 4% withheld, another amount withheld, or to waive having any deferrals withheld from that bonus. It's important that you be consistent with that and giving all employees the opportunity, the same opportunity. Excluding part-time employees from the plan, you want to be careful of that. Make sure that generally in most plans, part-time employees cannot be excluded from plans, but if they can be, just make sure that the document says that they can be. And don't forget that part-time employees, even if you had a 1,000-hour requirement, can easily and very quickly add up their hours to 1,000, which would make them eligible for the plan. So make sure that the document is correct and reflects what you're doing. You don't want to exclude anyone from participating in the plan if they are not excluded properly in the plan document. Another very common error is matching catch-up contributions. The document will say whether or not you are matching catch-up contributions. So for example, someone is contributing over the $19,500 maximum deferral limit for 2021. If they want to defer an extra $6,500 because they are over age 50, well, does the document allow you to match contributions that are catch-up contributions? Most plans do allow for that. So you want to make sure that you're not missing that and that you are appropriately matching those catch-up contributions if the document says that you are supposed to. That is a very common error. Not distributing the summary plan description to participants is another common error. You want to make sure that your participants are receiving what we refer to as the SPD, so that they have information on the plan, including eligibility, how they can take their money out of the plan, and who they contact if they have any questions. Not allowing new employees to participate pursuant to the plan. So if you have a new employee that becomes eligible, it's important that you notify the employee that they are eligible and allow them to enter the plan on a timely basis. There can be consequences to the employer for not doing that, which could include having to make up contributions to the plan for the employees. So it's important that you do that. Another very, very common error is not capping matching contributions. So at the end of each year, even if you're making your contribution on a payroll basis, we will look at the matching contribution to make sure that no one is exceeding the maximum cap on the match. For example, if you're matching 100% of deferrals up to 4% of compensation, at the end of the year, we'll look at that to make sure that no one is exceeding the 4% of compensation. But this is something that can be prevented in making sure that your payroll is set up properly, or whoever is calculating the matching contributions on a payroll period, to make sure that no one is exceeding it. Okay, here are some examples of corrections for not allowing a participant to enroll on time. This plan does not have an age or service requirement, but it does not offer Steve his enrollment until 6 months later. So the employer will be required to make the participant whole by making an employer contributions for the missed deferrals and the match. So so this can be costly to the employer too if you don't stay on top of this. You want to make sure that participants are being properly notified of their eligibility to participate in the plan, and that they are enrolled timely. If a participant does not want to participate, it is a good idea to get to have them sign something saying that they don't want to participate, so that you have it for your records. Not properly capping the matching contribution. So if somebody exceeds more of the match than they should have, then here's an example of someone who the maximum match is $8,700. If they're receiving more than that, then the correction would be to forfeit the match and along with earnings. So this is something, like I said, that we look at the end of each year. But ideally, if it would be better to be proactive and be able to set up your matching formula correctly so that it doesn't happen. Okay, some basics on eligibility. Before you can consider if a participant is eligible to receive employer contributions, and the first step is the initial eligibility. So the maximum waiting period that you can require in a 401k plan is that they work 1 year of service and be age 21. With a minimum of 2 entry dates. A certain number of hours may be required during that 1 year of service, but it cannot be more than 1,000 hours. And of course, the age requirement cannot exceed age 21. You can always have shorter waiting periods, like 6 months, 3 months, or you could have no waiting period at all. You could allow participants to come into the plan immediately. Once the initial eligibility is met, then the next step is to determine what the entry date is, and that is all in accordance with the document. So they may be able to come into the plan immediately, but the next entry date is the first of each month. So the first of the month after a participant's date of hire would be when you allow them to enter the plan and start making deferrals. The initial computation period for a 12-month requirement or 1 year of service requirement is initially from the date of hire through their 1 year anniversary date. And then it typically changes to the plan year. So for example, let me just show you this example. So if someone is hired June 1st, 2021, their anniversary date is going to be June 1st, 2022. And so the first thing you look at is whether or not someone worked 1,000 hours during that period. If they do, then they can come into the plan on the next entry date, which happens to be July 1st, 2022. If the employee doesn't have 1,000 hours during that first 12 months of their employment, then the document would typically shift to the plan year. So that means that the next period you're looking at is whether or not a participant worked 1,000 hours from the first of the plan year, January 1, 2022, through January 1st, 2023. Did they work 1,000 hours during that period? If they did, now they're going to come into the plan January 1st, 2023. So as said, the initial period of time that you're looking at is from the date of hire through the anniversary date. And if they don't have 1,000 hours during that period, then you start looking at the plan year. If you have any questions about eligibility, please do not hesitate to contact your account manager, especially when dealing with rehires and people who haven't worked 1,000 hours for several years. Maybe they were per diem and now all of a sudden they're full time. It can be a little confusing. So so don't hesitate to call if you have any questions on eligibility. As mentioned, rehires can be a little tricky. If a participant was formerly eligible, then they do not lose their prior service credits. So that's important. We wouldn't make them, if they had a year of service, then we're not going to make them work a year of service again if they had a single vested dollar in the plan. Otherwise, they can lose their prior service credits after 5 consecutive breaks in service. A break in service is when a participant works less than 500 hours. So if they don't have that in a 5-year period, then they can lose their prior service credits. If a rehired employee is eligible to enter the plan, has not lost their prior service credits, then they should be allowed into the plan immediately. So again, you wouldn't make them work another year of service if that's what your plan requires before they come in, and you wouldn't even make them wait until the next entry date. Let's say your entry dates are quarterly. You would allow them into the plan immediately upon rehire. Okay, that's all I have for today. I'm going to turn it over to Jason Worms now.
Thank you, Tina. And we're going to switch it over to me as presenter here. So bear with me just a moment while we get that going. Okay, I think we are going now. So we're going to speed through this last half hour. There are a couple of pieces that I'm going to spend a couple of minutes on. One of these is this kind of revisiting the moving pieces section. Tina did a great job earlier talking about the difference between the record keeper, the TPA, and the investment advisor, so I'm not going to belabor this point. But in case you're not a pie chart person and more of a columns person, here's another way of showing it to make it stick in your brain a little bit better. But some questions that kind of test these relationships and who does what, for example, is how does money get to the record keeper, right? So, you go onto your John Hancock, Transamerica, Empower website, and you upload the contribution information. Most of those websites have a feature where you can select a direct debit from your bank account, or they provide instructions for mailing in a check if you're a little more old school. And then the Once those funds arrive, then the record keeper breaks down that contribution amount in the way that your breakdown told them to, and then they keep track of those funds for each person by money type. So they keep the 401k deferral separate from the employer match, et cetera, et cetera. So that process happens almost exclusively with the record keeper. Your financial advisor, your TPA are rarely a part of that process unless there is something wrong or there's a question about what money type a contribution needs to go into. Who calculates the employer match? So a lot of people will think, well, after his last example, maybe the record keeper calculates the match for us. That is not correct. Usually the match is calculated by you as the plan sponsor if you make that match contribution on a per pay period basis. So with each deposit, if you put in the match as well, you are generally the one who's responsible for making that calculation. Nova will still check your work. At the end of the year, we'll do the aggregated 401k contributions, the aggregated employer contributions, and we'll check to make sure that everyone received what they should have using the match formula. But we're not going to be checking it on a per pay period basis. However, if you don't make your match on a per payroll and you make your match in one lump sum deposit at the end of the year, then Nova will calculate that match for you. So you don't have to worry about having your payroll system set up appropriately or anything like that. You just provide us your annual information, the compensation, the contributions made by the employees, and then Nova will give you a dollar amount broken down by participant of what the match should be for the year. So either way works. Both are completely allowable by law. It's just a matter of preference and what your company deems is the more important priority for you. Moving on, another thing that gets prepared for you is the Form 5500. So in probably every case, for the 100 or so of us that are on this call today, Nova is going to prepare the Form 5500 for you. Okay, if you've engaged Nova for compliance work, the Form 5500 is often considered part of the compliance work, and Nova is going to prepare that form for you. You as the plan sponsor are going to be the one who's actually signing that Form 5500. Okay, as the plan sponsor, you bear ultimate responsibility for the plan, just like you're the one that signs the plan documents. And so you'll be the one who electronically signs the Form 5500 and submits it to the Department of Labor and the IRS. Nova walks you through that process, provides step-by-step instructions to make that happen, but ultimately it is your signature that goes on that form, just like it is your signature that goes on a distribution form or the plan document. Speaking of distribution forms, the next question is, how does an employee get distribution paperwork? For the diminishing number of plans that use paper forms still, we always say it's a good process to include distribution forms for the 401k plan in your exit interview package. So when you're giving them the COBRA notice and all that other stuff, include the distribution form for the plan in that package. It makes it easier. You don't have to go request it separately. And it gets you a higher turnaround rate for those. Nova 401k associates can mail distribution forms to participants upon request. So if you can provide us with the participant's name and their most recent address, we will put that in the mail for you. Most of our record keeper partners these days do offer online distribution requests. So they can log into their account on the website and they can start the distribution process there, and in some cases complete it entirely electronically, even doing an electronic signature on the forms. So be aware that that is an option that's becoming more and more available. All right, probably most plan sponsors' least favorite job that they have is distributing required notices. So this is just a sampling of 6 notices that many retirement plans have, and they have to distribute on an annual basis. Okay, so we got things like the summary plan description when you have new hires or when you change your plan provisions. Summary annual report has to go out every year. Special tax notice has to go out to everyone who's requesting distribution forms. Fee disclosure notice has to go out on an annual basis. Safe harbor notices and automatic enrollment notices, if your plan uses either of those features, those notices have to go out annually. So it's a lot of effort to send these notices out. As the plan sponsor, it is your responsibility to make these happen. Okay. Nova does not offer notice distribution services. We prepare many of these notices for you and make them available for you, but ultimately as the plan sponsor, it is your responsibility. However, if looking at this list of notices makes you a little weak in the knees, we do have a sister company that does notice mailing services. So it's Administrative Fiduciary Services, or AFS for short. And what they do is they take care of notice mailing. So they will confirm with you your address list of your participants, and they will take care of all the mailings for you. They will keep track of which notices are required, what dates they need to go out, and they will get them in the mail. So if that is something that sounds good to you, I encourage you to save this slide and contact Jake, who is the email address that's there, to see how that can help you out. All right, now moving on, probably the thing that you are going to get the most questions on as a plan sponsor throughout the life of your plan has to do with distributions. And that's because everybody wants their money at some point, okay? No dollar that goes into a 401k plan is designed to stay there forever. It's all designed to go to a participant when they retire or when they terminate employment. And so everybody's going to use this service at some point in the plan. But you know, the IRS says that once this money is in the plan, it has to be used for retirement or for very specific things, okay? So what the IRS does is places restrictions on how you can get at these funds, okay? You can distribute money from a 401k plan generally for one of the following 4 reasons. A person can terminate employment, whether that's voluntary, involuntary, retirement, whatever. If they stop working for you and the employer no longer considers them an employee, they can access their funds. If they're age 59 and a half and the plan allows it, if they qualify for a hardship withdrawal and the plan allows hardship withdrawals, if they pass away, or if they become totally and permanently disabled, again, if the plan allows for those distribution options, okay? Now, for the death, that obviously would be considered a termination of employment, right? So that is a kind of a required thing. Disability is a little bit more wishy-washy, so which is why I put that qualifier on there. So for termination, this is your most common one. And we talked about the forms. The employee can submit forms early, as in before their last paycheck gets paid, but they cannot remove their funds until the last day worked. The reason for that is they're not actually terminated employment until their last day of work is passed, right? In addition, most record keepers, which is a good practice, will not distribute the funds until the final paycheck deposit has been made. So they will, on their distribution forms, they will ask you as the plan sponsor to confirm when the last deposit is going to be made, and then they'll make the distribution after that. The reason is because most record keepers charge fees for the distribution, right? And they don't want to charge a second fee for a second distribution request because the money was distributed before the whole thing was there, okay? And we talked about the tax notice a couple of slides ago that has to be provided along with those distribution forms. For record keepers that do online distribution requests, the tax notice is provided electronically at that time as well. So, so that's how they cover that. All right, age 59 and a half. Again, this is not a required distribution option. Many plans do it, but not all. Participants who reach the age of 59 and a half can offer employees the ability to take a distribution of their account balance, okay? Why age 59 and a half? This is from the IRS. Age 59 and a half, if you don't know, is the age cutoff where if you take a distribution from an IRA or a 401k plan that you don't get assessed the 10% early withdrawal penalty. The IRS says if you've made it to age 59 and a half, you're close enough to retirement to start making preparations for retirement and maybe start to draw down your retirement accounts. Why 59 and a half was settled on, why it hasn't changed in the 20 years that I've been in this business, I cannot say, but 59 and a half is the date that, that is put into law by the IRS. Hardship distributions, again, this one is not a mandatory field. So you can allow this in your plan or you can choose not to. It is a nice benefit for participants who are struggling, but it is also a bit of an administrative headache for the plan sponsor to offer. So it is a balance on whether this is a good call for your company. What it does is it allows employees to access their 401k account in the event of an emergency, okay? If they're under the age of 59 and a half, they would still be subject to the early withdrawal tax, but again, they could access these funds earlier than they otherwise would be able to. There are only a couple of reasons that you can take a hardship withdrawal. I'm not going to dig into these in too much detail due to time constraints, but print off this slide, if you do allow hardship withdrawals, keep this at your desk because these are the types of questions that you're going to get over and over and over again. Your Nova account manager has no problem giving you this list as often as you need it, but it might be easier for you to keep this somewhere at your desk. If you've been in the business a while, the hardship withdrawal rules have changed. They changed in 2019, which is getting further and further away from now as we go. But you may remember that you used to have to take a 401k loan out of the plan before you could take a hardship. That's no longer a thing. You used to have to stop making 401k contributions to the plan if you took a hardship. That is no longer a rule. You used to not be able to access your investment earnings when you took out a hardship withdrawal. You could only take out the money that you had actually put in. That is no longer a restriction. Certain employer contributions were not allowed for hardship withdrawals. That is no longer the case. So there's been a lot. This 2019 was a big deal as far as making hardship distributions easier and higher value for participants, for the plans that choose to allow them. Okay, talking about death is never fun, but we're going to plow through it. The funds are distributed according to the participant beneficiary election. Beneficiary elections are specific to a 401k plan. So it doesn't matter what your trust says or what your estate plan says or what your life insurance policy says. You have to have a beneficiary election for the 401k plan, and that overrides literally everything else, okay? If you have a participant who is married and they select someone other than their spouse as their primary beneficiary, the spouse must consent to that beneficiary name, and that authorization from the spouse has to be notarized in order for it to be effective, okay? And then if you get to a situation where a person passes, doesn't have a beneficiary designation, whatever, the plan document actually specifies what the order is of who can claim that account in a beneficiary situation. But best case, and what I highly recommend to all my plan sponsors, is just like Tina was talking about, having a deferral election, even if that election is 0 on file, have a beneficiary designation on file for all of your people. Okay, it just saves a ton of headache if somebody passes away. Okay, age 72 distributions, better known as required minimum distributions, or RMDs for short. This is if you reach the age of 72 and you're still working, the IRS would like you to start taking distributions out of your plan. Why do they do that? Because the IRS likes money, and forcing you to take a distribution out of the plan generates taxable income, which generates taxes. So that's kind of the reason for this. If you are not an owner of the company, and by owner means more than a 5% owner, and you are still working, you can delay starting your required minimum distributions, okay? But if you have terminated employment, or if you're more than a 5% owner in the company, when you turn age 72, you have to take your first distribution, and then you have to take them annually thereon until your balance is 0 or until you pass away. Qualified domestic relations order is another distribution option. This is in the unhappy circumstance for most people of a divorce. So this is one of the only reasons allowed by law that a person's 401k account can be given to another person, okay? And it's only in this divorce decree. It has to be a court order signed by a judge, and it has to provide specifics on how the account gets split. The rules on quadros are complicated, so please contact Nova if you have one, okay? We will absolutely help you figure it out, tell you exactly what you need to do, and help you split the account with the record keeper, okay? So these are services that we offer. Use our expertise, because you can definitely go blind trying to read all the rules that are written about quadros. All right, spousal consent is becoming less and less of a thing. It's not a requirement for most plans, but there are still some out there that do require spousal consent. The spousal consent rules say that if you have a distribution that is over $5,000 and you're married, your spouse has to sign off on it, okay? No ifs, ands, or buts. This slows down the process because you got to get another signature in order for you to process a distribution request. That is not necessarily a bad thing, but it's something that you need to go into eyes open if you have the spousal consent requirement. Like I said, this used to be a requirement. It is no longer required in all 401k plans. So there are just a small amount left over that still have this requirement. But if you're not sure if you have this or not, talk to your Nova account rep, we can tell you. Okay, we're gonna move on to loans next and probably wrap it up here. So participant loans are popular, similar to hardship withdrawals. Participants love them because they can access their funds. From a plan administration standpoint, they are a pain in the neck, okay? They require you to set up additional things in your payroll system. You've got to track down people, you've got to send forms to various places. So it can be a burden on your administration if you don't have time for it. But like I said, they are a big benefit from a participant standpoint. So again, some plans choose to do them, some plans choose not to. There isn't a right answer, okay? It just matters what your goals are with your plan and what your goals are for your participants in their retirement. If you do allow loans, participants can borrow up to 50% of their vested account balance or $50,000, okay? If you're a serial loan taker, that $50,000 balance gets reduced based on their highest outstanding loan balance in the last 12 months, okay? Most plans provide a minimum loan amount. Generally speaking, it's $1,000. So a participant has to have a vested account balance of at least $2,000 to take a loan out, okay? Loans must be at a reasonable interest rate. You can't send them out at the prime interest rate, okay? Nova, for example, does prime plus 2 percentage points, all right? Loans must be repaid within 5 years unless it's a residential mortgage loan, okay? Almost nobody gets a mortgage loan out of their 401k plan, okay? Almost nobody. Loans are paid through payroll deduction, okay? We don't want participants mailing in individual checks to your record keeper for loan repayments, okay? They almost always forget at some point. They rarely provide all the information the record keeper needs in order to apply the funds properly, et cetera, et cetera. It is much better for just to come straight through payroll deduction. Loan repayments are after-tax payments, so they do not get any tax pre-tax benefits like a 401k deduction does, okay? If you have a loan outstanding and you terminate your employment, either voluntarily or not, the loan becomes due immediately and in full, okay? So that is a risk for people who are taking out loans, especially large dollar loans. Loans could have an initiation fee. They also could have a maintenance fee, and those fees are almost exclusively charged to the participants who take them out. It is very rare for a plan sponsor to cover the cost of loans anymore, but it does happen on occasion. Most record keepers, because people who take loans, generally speaking, are trying to get the money quickly, they have an online loan application. Some still do offer paper, but again, that slows down the process. You can also, many of them can request a direct deposit of the loan proceeds into their bank account instead of getting a paper check that has to go through the mail, and that can shave off multiple days from a process. So if you got someone who's trying to get their money quickly, the ACH and doing it online is the way to go. Okay, these next couple of slides are the annual calendar. I'm not going to go through it because we don't have the time at this point for that, and I do want to get to your questions. But I'd highly recommend that you bookmark, save, print, whatever you want to do for these next, I think it's 4 slides to get through the entire calendar. Not all of these things apply to every single plan, but it's a good thing for you to keep and maybe highlight the stuff that you know applies to you, or to ask your Nova account manager, hey, which of these things applies, so that you can keep yourself on track to have a successful year for your plan. Most of these things happen every year, so it'll be a good kind of reminder and timeline for you to keep on top of your plan sponsor duties. Okay, we have more upcoming webinars. There's the link here, and I'm sure Yvette's going to send that out when the time comes. And I think, Yvette, we are ready for questions. So have we had any submits so far?
It doesn't look like there's any questions right now. If you want to go over the last few slides that you had, we got a couple of minutes left. In case anything pops up, I will let you know.
Okay, great. So Tina mentioned this at the beginning, but if you are attending this webinar for CPA credit, there's an evaluation survey that is going to be coming out afterwards. You will receive the certification for the CPA credit via email within 1 week after you complete that survey. So, so definitely, if you're here for continuing education for CPA credit, make sure to pay attention to that. And I am going to go back quickly through the calendar then, since we have a couple of minutes. So we are in April, so I'm not going to do the first 3 months, but if we've made it to April, where we are right now is we're a week away from the excess 402G refunds due. Okay, so if you have a participant who deferred more than $19,500 in the year and they're not age 50, then that excess amount has to be distributed to them by April 15th in order for them to avoid excise taxes. In May is when Nova's going to start preparing that Form 5500 for you. Okay, so that's going to be sent out to you in May for your signature and to electronically file with the Department of Labor. If you are a large filer, which Tina talked about earlier, if you haven't already, I highly encourage you to contact your plan auditor and get on their calendar. Okay, their spots are going to fill up fast, and especially if you do not want to extend the due date for your Form 5500, you want to have your audit start in May if you can. Okay, Nova is going to be working hard to get the draft of your Form 5500 to you and your auditor in May, so that there's enough time for you guys to complete that work prior to the July 31st unextended deadline. Okay, let's see. Nothing really in June for you guys. July is a big month because July 31st is the Form 5500 due date without an extension. Okay, Nova does not file extensions because we need extensions. We file Form 5500 extensions only because you as the plan sponsor need them for whatever reason. Either your audit isn't complete, you're waiting on a Schedule C or a K1 in order for us to complete the compliance work. There is something wrong and you haven't been able to get your census data to us yet. You know, those type of situations are typically the reasons why we extend your forms. You should not have a situation working with Nova where your form has to be extended because we aren't able to get our work done. Okay. Once the deadline passes, we turn to August, which is when we start looking at doing mid-year testing. So if your plan is not safe harbor and is subject to the ADP ACP requirements, we offer you the opportunity to do mid-year testing to see if your plan is looking like it's going to pass or fail for 2022, and so we can make any remedial things that we want to do at that point. In September, if you filed your Form 5500 without extension, then your summary annual report should be distributed to all your participants. Okay. It is also when Nova does our mandatory distribution process, or cash outs for short, and that is where we take all the folks that have terminated employment with a vested account balance under $5,000, and we help you get their balances out of your plan. Okay, that is a fee savings for you because you get rid of a bunch of small balances and terminated employees out of your plan, and many record keepers especially will decide on your cost based on the average account balance in your plan, right? So if you're removing a lot of small account balances, then your average account balance goes up and you get better pricing from the record keeper. Okay, moving on to the last quarter of the year. October is the drop dead date for Form 5500. So if you extended your form back in July, then October 15th is the last day that you have to file your 5500 and have it done timely. Okay. October is also when Nova begins working on the required minimum distributions for people age 72 to make sure that they all get processed by the end of December. I know it seems like 2 months is a long time, but there's two pretty important holidays in there for the majority of us, and that adds a lot of sand in the gears for the process, is one way to put it. When we get into November, November is the busiest notice mailing month of the year. So a lot of times your large plans that filed close to October 15th, that's when they're distributing their summary annual report. It's also when your safe harbor notice, your automatic enrollment notice, your default investment notice, all of those things have to go out in that month. December is the big month because a lot of people are on vacation, but it's also when the deadline is to make corrections to a plan, to amend your plan if you're making any changes to it. And importantly, if you're one of those participants who's over the age of 72, your required minimum distribution has to be out of the plan by the end of the year. Okay. So I see the clock ticking from 2:29 to 2:30, which puts us right on time. Tina, any other questions come in while I was yammering there?
We don't have anything coming in, so we can go ahead and wrap it up.
Okay.
So I want to say thank you to Jason and Tina for your time today. And thanks again to everyone for joining us today. Just a reminder to fill out the survey at the end of this webinar so that we can track who will be needing a certificate. If you have any questions, please be sure to email us at webinars@nova401k.com. To view any of the previous webinars you may have missed, including this one, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thanks, everyone. Enjoy the rest of your day.
Thank you. Have a good afternoon.
Thank you.